So today I'm bringing back an old series that we've not done for a while, which is the free UK stocks to buy, and it's going to be the month of June. So I thought, you know what, I've not done one of these for a couple of months now, but it's a really good series that always used to do well, so I thought let's bring it back. I'm going to talk about free stocks that I am looking to buy in the month of June. I do currently own all three of these stocks at the moment, and I will spend a couple of minutes on them, but if you wanted a more deep dive, there's already a video on the channel somewhere. But like I said, these are the potential free stocks I'm looking to buy in the month of June. Now, there's obviously, with the bear market that's going on and the stock market crash that's currently going on, there's actually more than 3 opportunities that I could have put on here, that I could have had another video with 3 potential stocks, but I thought I'd go for the 3 that in particular look to me the strongest buys in the month of June 2022. So we'll take a look at these. And as always, if you want to join the Patreon, the link's in the description. On there, we have a Discord with 600 members on to talk to about stocks. And also there's 2 exclusive videos a week on there. One of them was this video that went up yesterday, which was the stock request, and on the Patreon or the Discord, the members voted for a bit of a review of Oatly, ChargePoint and Nintendo. So if you do want exclusive content to join that, the link is in the description. And just to shout out, yesterday I said if you could smash the like button, that'd be absolutely amazing, because without the like button being smashed, unfortunately the views do not do as well. But recently the like button has been smashed again and the views have gone back up to doing very well. So you can see here, like, the like button was absolutely destroyed yesterday, and once again it pops up as being the #1 video. So I don't say smash the like button just for the sake of it. There's actually a reason to it. It massively helps with the algorithm, as you can see here with yesterday's video. But we'll take a look at these 3 UK stocks. So #1, and definitely the priority going into the month of June, is Hollywood Bowl. So I am trying to build up this position a little bit more now going forward. I am currently up over 50% on this position, so I will be averaging up a fair amount on this position. However, I don't mind, because I still think the upside on this is very good. And I was very confident on Hollywood Bowl previously. I had a lot of confidence, and I've always said that I should have really bought more of this position, and I didn't. Now I'm seeing their recent update, it just gives me more confidence and more confidence to buy. So the ticker symbol for this one is BOL. It's currently around about £2.50. At the moment, I think that Hollywood Bowl should already be a £3 stock. If we weren't in a bear market, I think it would be there. And in the longer term, I think it will 2x from here. It's a very low valuation. It puts in good amounts of growth as well. And it's also gone back to paying its dividend as well, which is really good. As you can see, it's down at a P ratio of 10 at the moment, which is extremely cheap for a company that's doing the numbers that it is doing. And as well as that, you know, a nice little bit of a dividend you'll be picking up here, and they have potential to carry on hiking that dividend up as well. Now, if you don't know what Hollywood Bowl is, the clue was in the name, but they do have bowling alleys, but they've been more diverse with their income recently, because they have the bowling alleys, but as well as having the bowling alleys, they also have their arcades, which bring in good amounts of revenue. They also have their bars as well, and the food service side of it, and also have put stars, so they also have a bit of a mini golf. That depends on sometimes they're built into the Hollywood Bowl location, sometimes they're built separate. So there's a lot of different income streams that they do have going on here. So potentially, even if you don't want to go to the bowling, for example, these are kind of always tied into like leisure complexes near like restaurants and cinemas. So potentially, even if you don't want to go bowling, you might go to the cinema and then you might pop into the arcade, for example, at Hollywood Bowl, or go to one of the bars at Hollywood Bowl as well. So that has really helped with the revenue and income and like-for-like sales, because they have so many more different incomes coming in right now. And as well as that, they have announced a big massive expansion plan, which we'll talk about in a second. So if you do look at the recent interim results, they were really impressive. Revenue was up 36%, group adjusted EBITDA was up 46%, group profit after tax was up 52%, and the interim ordinary dividend as well was up 32% compared to H1 financial year 2019. So yeah, they've gone back to a higher dividend than where they were at pre-CV situation, and that's because they're also so much better than where they were previous to the CV situation. However, like I said, when you look at the share price has no reflection of this. Like I said earlier, the share price is still not where it was at pre-CV situation, which was £3. And like I said, when you look from a financial point of view, the company is well ahead of where it was pre-CV on a revenue basis, on a profit basis, on a dividend basis as well. And where the path is for the improvement in Hollywood Bowl is opening up new centres, refurbishing centres, making the gross margins better through cost cutting, through pins on strings as well, and also some other things. So you can see here they had 2 new centres, which was the Hollywood Bowl location Birmingham and World Putt Darts Harrow. 2 refurbishments to try and get them locations to bring in more income, a AMF in Shrewsbury refurbished and rebranded as Hollowed Ball, and 3 centres had solar panels installed, obviously to help with efficiency, gross margins. If you look here, amusement revenue, like I said, there's loads of different incomes here, and you can see the games like-for-like volumes were up, the amusement revenue was up 43%, which is impressive. Food revenue up, and drinks like-for-like revenue up as well. And if you look here, pins on strings, which is also helping with gross margins, was installed into 7 centres. And with 9 more planned before the year, meaning that will also help with gross margins in them locations. And the new breaking news with Hollowed Ball is they're actually planning to expand internationally as well. So they've acquired a Canadian bowling company called Splitsville in Canada, and they are gaining some locations from them, and also they have a pipeline to extend the location. So Hollowed Ball now is going from just being a UK company to a UK and Canadian company, or international company as well, which is great. So that could be really the big growth driver for this company in the coming few years, is when they carry on increasing that revenue and profit from the Canada's part of the business, and as well as expanding through there, replicating that whole ball business over there with the arcade, the bar areas and everything as well. And also Hollowed Ball Belfast opened in April 2022, and 2 new centres are planned to open within the next 6 months as well. So you can see this is where the pipeline of revenue and profit growth will be in the next few years, is carrying on opening up some more UK centres and refurbishing to get more better revenue from them, as well as that expand that international presence into Canada a lot more as well. And like we were saying earlier, the valuation on this one is really attractive, because at 10 times earnings, it's pretty good. Currently to Simple Wall Street, they currently work it out as a 2.4% dividend yield. I don't know if they're working that over a course of a period, whereas Google aren't. You can see the payout ratio is only 13% as well, which is very healthy. And yeah, you can see that the profit and revenue is much higher than where it was pre-CV situation. I'm not exactly sure why analysts are predicting a slowdown here in revenue and profit. I don't know if that's totally correct, because I would expect when the new venues and the gross margins, that would carry on improving. So I'm not sure analysts are going to be completely right there, to be honest with you. But when you look at the financial health of it, it's very healthy as well. Recently paid down all its debt at 0% debt to equity. It's sitting on a very good cash balance now of 50 million for a 400 million market cap company, which is very healthy as well. That's why it can now go back to paying a dividend, why it's acquiring companies as well, and can carry on improving the business, which is great. Ownership wise as well, there's been quite a bit of insiders buying over the last 12-24 months as well, which is really positive. So yeah, overall I believe Hollowed Ball definitely has a 100% upside here in the next 5 years, and that's not including any dividends gained from this company as well, which it could easily hike up with the amount of profit it's generating at the moment. So number 1 is Hollowed Ball. Number 2 is probably what I would say is the best UK growth stock on the stock market right now. It's a fantastic UK company. We don't normally get in the UK stocks that come onto our listings that are like this, that has so much potential, so much in its early days with a big massive future ahead of it. And I think S4 Capital is a lot different from a Hollowed Ball. Obviously, it's a lot more in its early stage of generating a lot more revenue than profit, and profit will come further down the line. But at the same time, I would not expect to double up with S4 Capital. In my opinion, in the next 5 years with S4 Capital, I would be looking at something more towards a 3x to 5x easy from these sort of valuations here. So that's what I would say something like an S4 Capital is at the moment. Now, S4 Capital is a digital marketing company that's led by Martin Sorrell, who is one of the reasons why I got into this, because I think he's a great founder with a great experience in this industry, and I think he's going to lead S4 Capital to be somewhere between a 5 billion to 10 billion market cap in the next few years. Now, at the moment, it is on a massive downtrend. It got caught up in this kind of stock market crash that's kind of been going on recently, this bear market. But in particular, there's been a bit of a fall off recently that's basically led shares to go back to the prices it was at nearly 2 years ago. Now, the reason for that share price drop is because S4 Capital auditors would not sign off their financials, and with an auditor basically not signing off financials, everyone automatically goes, oh, okay, there's some fraudulent numbers going on here, and everyone goes straight away to worst case scenario about S4 Capital. Now, it has finally been confirmed that the numbers with S4 Capital weren't that badly incorrect. It turned out there was some reporting numbers that was slightly wrong, and I think it only turned out that revenue was incorrect by 1% or something, which wasn't massive. And I think as well, like there was no other previous financials that were incorrect. There was no cash balances that were reported wrong. So the impact of this audit issue wasn't even that big for S4 Capital. However, what it did lead the share price to do is, at the moment, S4 Capital is valued at 1.6 billion. This impact, because everyone went worst case scenario because of this news, it ended up S4 Capital losing 1 billion of the market cap. Now you look at today and it turns out the issues have kind of disappeared. Everyone's fine with the numbers and everything's back being in the positive for S4 Capital. What impact has that had on the share price? Well, it's nothing. In fact, it's nearly at its 52 close still. So even though one of the big concerns that cost it to lose 1 billion on its market cap has now disappeared and it wasn't a big issue, it has not benefited the share price at all. So at the moment, S4 Capital is still priced down as its worst case scenario, still a fraudulent company and it's faking its numbers. And we've pretty much moved away from that now because obviously the auditors signed the numbers off. And also we've also had the newest quarter out from S4 Capital, which is just crazy. So at the moment, I mean, S4 Capital, in my opinion, should be already a £5 stock. And then when you look at the potential in the next few years as well, it's kind of crazy for this opportunity here. And like I said with S4 Capital, they recently came out with their first quarter trading update this week, and the numbers were very good. The gross profit and net revenue growth continues ahead of market guidance. So even in this time, how many companies have you seen struggling, especially in the area that S4 Capital is in, which is, this digital marketing area. You look at Google, you look at Facebook, a lot of those companies in that kind of advertising space are struggling, and S4 Capital still keep delivering, which is even more the impressive thing here. Reported revenue was up 70%, which is great, up 40% like for like, with gross profit up 64% and 34% like for like. And you can see here that even despite the slowdown forecast of global GDP growth, they're still expecting the digital marketing space to carry on growing massively as well. The company is still having a long-term game plan of leading 25% like-for-like sales and gross profit growth and steady improvement in operational EBITDA margins in 2022. 2 further whoppers as well were added, making a total of 8. So those are major clients that they've taken on as well, which is very positive for the company. And we don't have any P ratio to go off here. However, the company does trade down at 2 times sales, which is incredibly cheap for this sort of company. And if you look at the gross margins of the business as well, it's 81% gross margins, which is very impressive as well. And if you look at the financial performance of this company, you can just see how impressive this company is. Like we said, it's valued down at like June 2020 prices when it was doing 268 million. I mean, now we're talking about a company that's going to go on to do, by the end of the year, 961 million. So by the end of this year, this company would have quadrupled their revenue, and it's got no reflection in the share price at all, which is just unbelievable. It is losing a bit more money at the moment, but that's obviously due to reinvestments into the company, obviously buying a couple of companies as well, which is fine. It's very much controlling its costs and reinvesting into the company. Without doubt, in the next few years, the company is going to go back to going to do very good amounts of profit. It's got very good gross margins. So yeah, I won't be too surprised to see profit really start ramping up in the next kind of few years, without doubt. And when you got 80% gross margins and you're doing over 1 billion in revenue, I mean, very easily you could be talking about a company that puts 20, 30, even 100 million on the bottom line. And then that looks so cheap at the moment for a company that's growing this quick as well. Financial health wise, it's not too bad at 38% debt to equity, and it does sit on 301 million in cash, which is pretty good for a 1.5 billion market cap company. And like I said, it's there's been quite a bit of insider buying, and like I said, it's Martin Sorrell who leads this company. He's the founder. He owns a 10% stake in the company as well, which is pretty impressive as well. So that's another thing why I'm really bullish on this company. So that's number 2. And number 3 is a company that I've not actually mentioned on the YouTube channel for a long time, which is Airtel Africa. So yeah, this company's done absolutely amazing over the last few years, where there's a lot of companies at the moment are being caught up in this bear market and a lot of stocks have crashed. This is one of my stocks that's actually managed to perform pretty well at the moment. Even when all these stocks have been going down, this has just seemed to be going up and up and up. If you look through 2021, for example, when we kind of started to peak out, you can see it's up over 100% in the last year and a half, which is fantastic. And even with this gain in the share price, financially they're well ahead of expectations. and as well as that, it's still incredibly cheap at these sort of valuations, which is the scary thing. Now, this is probably the least known stock on this list, and what they basically do is they do telecommunications in Africa, so 14 countries in Africa, as well as telecommunications. That's through obviously the voice data or voice communications, but also mobile data, which is very popular in Africa because there's not that much infrastructure in like what we traditionally would have for a lot of Wi-Fi usage. And as well as that, it's also got its banking license as well. So it does a lot of mobile. It's like a bit of a PayPal kind of system that they have as well that's going on. So they've got the telecommunications and they also have the finance side of the business as well. It's quite a decent sized company actually. It's recently just come into the FTSE 100 at 5.6 billion market cap. Like I said, it's still cheap at 11 times earnings, and it also pays a 2.7% dividend yield as well. And when you look in the recent financials that came out on the 11th of May, you can see here that reported revenue was really good. You can see operating profit as well grew over 30% as well. And like I said, this is like 10 times earnings. They paid down even more debt. You can see here leverage ratio improves to 1.3 from 2 in the prior year. With now 1 billion of debt now held. Board recommends a final dividend, so hiking up that dividend as well, which was 3 cents a share. And if you look at all the business, a lot of the business is growing in massive amounts as well. So if you have a look at the key financials here, you can see voice revenue was up 15%, which isn't a major driver. Like I said, the data is the big side of it, which is growing 34%. And like I said, the mobile money revenue as well, 34% as well. Those are the two key things to keep watching out for this company, is watching that data revenue and that mobile revenue keep going up very good rates. And yeah, as long as that keeps ramping up and growing like 20%, that's going to be very good for this company. And like I said, it currently trades down at 11 times earnings, which is so cheap for a company that's putting this amount of growth, pays a dividend as well, paying down its debt, 1.5 times sales as well. And you see here the growth in the revenue and profit side of it, and at the moment analysts are forecasting for this to only continue, which I can only agree with at the moment. I mean, if they can keep up the rates of like this, what they're doing at the moment, that would be insane, these sort of valuations. But even what I think, potentially that high kind of single 10% rates, this sort of valuation is very good for this sort of company as well. If you look at the financial health wise, the only really issue that I ever had with this sort of company is why I never made it a big position is because of the locations that it does operate in. I think it is open to a bit more political risks, I'll say. But the only other downside I ever had with it was the balance sheet. The balance sheet was a little debt heavy, and like I said earlier, they're paying down the debt now. It's now, it was 100% debt to equity nearly. It's now down at 62%, which is fantastic. And if you do look at the cash, they are starting to hold a bit more cash on the balance sheet here, which is a lot better. But that's because they're generating, really good amounts of profit now as well. So they can carry on, paying down that debt and also increasing that dividend as well, which they also have a very good history of hiking up that dividend as well, which you can see here. So that's the third stock on this list, Airtel Africa. Like I said, I think it has very diverse income, which is great. It's a very cheap valuation. It pays a dividend as well, and it's got plenty of growth here, and it doesn't look like that's going to slow down anytime soon, really. So yeah, overall, I would really, Hollow Ball is the main aim. I'll probably pick up some SL Capital when I can, and then I've just got to kind of work out how much I kind of average up on this Airtel Africa, because the only little concern I have is that it is holding up very well and it has performed financially absolutely fantastic, but will it have a pullback? I mean, I don't know, because it's such a cheap valuation. Will it still have a pullback? That's the only thing I'm kind of weighing up with this one. But I've been desperate to kind of average into this one a little bit more. But every time I think about it, it just keeps going up and up. And I'm just kind of weighing, do I just buy the bullet on this one and buy a little bit more? Because I am up over 100% on it. So yeah, 3 fantastic UK stocks, I think there. Like I said, 2 that offer good growth and dividend, and 1 in particular that focuses a lot more on growth. So I hope you enjoyed the video. And like I said earlier, if you could hit that like button, really helps the videos out, as I showed you earlier. That'd be absolutely fantastic. And hope you enjoyed the 3 UK stocks series coming back again. First time for a while. But that's the video for today, and catch you in a bit.